Thanks everyone for tuning in today. We want to talk about the kind of macroeconomic environment and where we sit today. Let's just start with the macro side. And I think one of the biggest, kind of conundrums out there is what's going on with US GDP. And we can look at these charts and it's very noisy. And we take this back to really after the global financial crisis. And I always like to show people that in most scenarios, we really run between, call it the mid 1% growth rate to the highs of almost 3% with a couple of aberrations there. And right now with the trade import data that we saw in the first quarter detracting meaningfully from GDP, it looks like we're going to get some of that back in the second quarter as looking at the trade deficit so far, that essentially we've erased about 3/4 of that. So we probably get a claw back there. But notice economists are actually forecasting one of the lowest growth rates that we've seen over the last 15 years or so. And so it's important to think about that because we've had this period of U.S. exceptionalism where the U.S. stock market has been one of the best places to invest of the U.S. We've been massive beneficiaries of capital inflows. The net investment position in the U.S., that is what is invested in the U.S. versus what we invest outside as Americans to the rest of the world, is now at over $35 trillion. That what you're seeing here is a little bit of reversal of some of those. So the question becomes is that, do we still have the exceptional trade? The market seems to think so today. Obviously, there's some challenges out there, but we're still finding value in the fixed income markets and specifically in some interesting pockets of credit. So what's interesting, though, is we've started to see kind of the U.S. economy underperform expectations. And so I like to bring this chart up to show, if you remember, 2023 was supposed to be the year of the recession. Almost every economist on the street was calling for a recession. The U.S. economy stayed resilient that period of time. So therefore, the economy outperformed expectations. Then those expectations got baked in early 2024. And although 2024 was still a solid year, you started to underperform expectations a little bit. Then all of a sudden, we got kind of this resurgence post-election. And now you see that the economy has really been kind of underperforming expectations. And there's a little inset on the chart as well, showing some of the components of this. And you can see that it's driven by essentially all the different sectors of the market today. Now, again, this doesn't tell you the level of activity. This does not forecast that there's some contraction out there. It's just the amount of performance of the economy relative to expectations via those various sectors that you saw up there. And part of the overhang we see out there is the tariffs. This is which you can see as the effective tariff rate really over the last century and a quarter. And on top of that, there's a forecast in there. You can pick your forecast. We just use the one from Goldman Sachs at looking at what that tariff rate, effective tariff rate, is scheduled to be. And it's about 13.7%. This is before the announcements of the tariffs over the weekend. As we all know that the tariff policy has been extremely volatile. It's on again, off again. It's I'm going to tariff you. I'm not going to tariff you. We got a great deal. No, we don't. Okay, you want to mess with us? We're slapping on another tariff. So it's very hard to stay on top of. But I think it's pretty fair to say that we're probably going to see an effective tariff rate somewhere between the 15 to 20% range. And when you look at kind of a street estimates, that's assuming that this latest round of tariffs from over the weekend potentially goes through as well. So again, this is a lot of consternation in the market. What you see in it has been driven by the tariffs. If you remember the markets back in April, we saw a sell-off across the board in risk assets. But also what you've seen is kind of some of the relaxing has led to those animal spirits once again. But the challenge is, as we saw, and I'll talk a little bit about the inflation section. Obviously, we don't have the inflation data as of that came out this morning due to compliance issues. But you did actually see tariffs start to show up in inflation data. And the thing is, the headline number was right on the screws for estimates. Maybe it's out to the third decimal place. They were a little off, but it was roughly in line. But core, that is stripping out commodity prices, did kind of underperform expectations. So what's really challenging, I'll talk about that a little bit when we get in that section, is that we saw some of the tariff exposure within the goods sector, and you're starting to see that start to really trickle into the data set today. And we know that there was a recent passing of the One Big Beautiful Bill recently. What this chart shows is the public debt out there that's subject to the what we call the debt ceiling. That's the blue line there, and you can see at times we've blown through the debt ceiling with the ability to kind of relax some of that. But notice what's happened now is that Congress in the One Big Beautiful Bill Act agreed to expand the debt ceiling by $5 trillion. So that's what we're kind of talking about on that intro on the Bloomberg News show out there. But the idea is that why would they extend the deficit by $5 trillion on the idea that we're supposed to be Doge? Remember 5 months ago, Doge was out there. Elon was the mascot. He was out there on stage with chainsaws talking about how we're going to cut the government spending. But with the One Big Beautiful Bill, not only are we increasing spending, but we've authorized Congress to spend up to another $5 trillion, subject to any time they want. So this is, as I said on that show, becoming a little bit of a conundrum out there on what the U.S. is going to do. Is this the only way that we can really drive growth is to spend? And this is not something that just happened under the Trump regime. It happened under the Biden regime. It happened under the first Trump regime, it happened during the Obama regime. You notice the pattern. It happened during the Bush regimes. It happened during the Clinton regime, although we did have a slight surplus for a short period there. But notice here that the outlays as a percentage of GDP, we are addicted to spending. And it's very rare that we have enough tax receipts and income to offset that. We got that as a small percentage back in the late 90s. But in general, we're running these massive deficits. And so notice that the spending as a percentage of overall GDP, it does not appear to be on a downtrend to me. And noticing that they're authorizing $5 trillion of more spending probably means that we're not looking to cut that anytime soon. And shown differently, you can look at it as a percentage of GDP. And instead of looking at that, now the previous one was the total spending as a percentage of GDP. This is how much we either generate above the amount that we spend. That would be a surplus. I think tax revenue over spending, or what we typically run is structurally a deficit. And so notice in this chart too how bad the deficits have become. There is no semblance of thinking about ever balancing the budget. They start with $1 or $2 trillion deficits. That's what we're running. We're on pace right now for over a $2 trillion deficit this year. And currently we're running at close to 7% of GDP. And so this used to be much more than we would do in recessions to try to combat the recession. But it seems like we've sure been very addicted to that. And so we put together a different perspective of this. And I thought this is very interesting too, where you say, okay, look at all the past like 7 or 8 recessions we've had. And let's look at how we've attacked that with the fiscal spending. And so this is looking at how much the deficit to GDP cumulatively changes over the months from the recession until you're declared out of that recession, and how steep the curves have become. Notice that each of the last 3 cycles, the curve has become steeper. And I wouldn't say longer. Maybe it's because they believe in the Bernanke thought from how they tackled the financial crisis. He said that his one regret is they didn't go bigger and they didn't go faster. We definitely did that during the pandemic. But if you actually took these charts and actually made them cumulative, not to where it's just during the recessionary period, but until one hits the next recession, you would see that these gaps get larger and larger and larger. And so this is just a fact of life. It seems like we're stuck with it with the One Big Beautiful Bill. And so this is something that's going to be, kind of an overhang on parts of the debt market for years to come. And so if you look at kind of, you change this into dollars and you look at what happened during the One Big Beautiful Bill. And again, we haven't updated this since it was actually fully authorized. So this is based on the Senate passed bill, which is very close to ultimately what got passed. You can see here that there is some savings. The savings appears to be backloaded. Some of that will probably come through growth is what their assumption. But notice how big the spending is. And so the net deficit is quite challenging. This is just simply looking at kind of the cost of the overall bill. So as I said, there's no semblance in terms of trying to really obfuscate this and really pretend like we're going to balance the budgets. And hopefully, what we can all hope for, and we know hope's not a great investing strategy or a way to run your country, but maybe we'll get some offsets in terms of the growth provisions on that side that will help over the long term. So let's go back to the macro data and just looking at kind of the survey data. These are what are called PMI surveys. They're not surveys of how you feel, but they're essentially looking at, is your business expanding or contracting? And so the index, when it's above 50, there's more respondents saying it's expansion versus a contraction. And notice here that then during periods of recession, both of these series dip below 50. We've had this kind of strange period where manufacturing has been the doldrums for the last 3 or 4 years, where it's been somewhat contractionary, except those couple of months back in 2024. But you've noticed that the services side has held up. And services did, I think we had a 49.9 1 month this year. But in general, it's held up quite well. And so I think that, you need to see some meaningful or prolonged contraction in both of these to really drive the economy into that recessionary area. So obviously we're on watch because of these things, but it shows that the activity has definitely slowed down. So it's not just a manufacturing slowdown, but also services, which is a meaningfully larger part of the overall economy. And so that's kind of the setup of economic activity. But when you start to dig into these series as well and ask the same question about your business cost, well, notice here, this is that prices paid continue to rise. So this isn't just manufacturing because of tariffs. By the way, this is before the copper tariffs have actually kicked in too. And we saw that big move in U.S. copper prices relative to the rest of the world due to that tariff the tariff price. Between tariffs and sanctions, I can't differentiate between the two these days. But in general, notice how high these time series are. It's very rare that you see these elevated periods of general price is paid going up. And so this is just why I point this out, is this tends to lead to somewhat a more inflationary behavior. If input costs are going up into businesses, you either have to raise prices or you have to eat that and eat margins. And so you can only eat margins for so long before some of those things have to be passed on to the consumer. And so another part of those, the ISM data is looking at employment. And so this is, are you hiring or contracting your labor force? And notice here, we're seeing quite contractions. Now, also notice that this period, these series can go into contraction, both of them, and not lead to some overall recession. It usually takes big, meaningful dip downs in these labor force measures to be able to get there. But they're definitely not signing that we're in a good state today. So again, it does not mean we're in a recession just because we're barely having that expansionary behavior. Just because prices are up, employment's down a little bit, doesn't mean that that there's problems to come. But again, it does put you on alert when one looks through this. And so again, these are things that we really look at. These come out usually the second to third business day of the month. And so these are updated as of June through the July releases. And so inflation's been on everyone's mind. As I mentioned, if you look at the components here, this actually is updated on the inflation data here. And so what you see here is the components of inflation when you dig into core inflation. So this strips out commodity prices. It's not the super core that Jay referred to when trying to ignore the inflationary effects. But notice what you see here and the persistence of that light blue area. Shelter tends to be a big driver, contribution to overall CPI. If you sum the bars up, they sum to that black line, which is the core CPI number. But notice there too that you see many periods where goods are inherently deflationary. And so we've noticed here, since the tariff policies have been talked about, since we've been liberated, that ultimately we started to see more core good inflation. And as I mentioned as a preview earlier, when you look at the core good inflation day, it wasn't really that bad when one looked at it. But if you actually stripped out autos, which have been extremely volatile, just given the front loading of purchases back in March before the April tariffs were supposed to kick in, during April, once they were announced and kicked in beginning of May, we saw a lot of activity trying to get there. You're seeing some of that payback today. When you stripped that out and took out autos, it was like 55 basis points month over month. So it's starting to seem like that core goods data is actually getting some of that tariff data into it. We'll have to wait and see. But in general, when you strip out the services and you strip out shelter, notice that's a pretty consistent contributor really since the pandemic. And so this is the kind of service areas, things you do. This is the travel season as you think through taking the kids to water parks and camping and going out there and spending money. So this is the other thing about tariff policy when you think about it, is that you can choose to forego the consumption of the goods, but what do you spend it on? Do you maybe go out and do more services as well? So we like to look at the mix of this. We're starting to see some of the tariff data show up, And if we continue with these tariff policies that are supposed to be implemented on August 1st, it potentially will lead to a little bit more inflation as well. So what's the market thinking about this? Well, you've seen the market break-even inflation rates. They've been somewhat noisy, I'll call them. They are at much more elevated levels than we saw through most of 2024. The big difference is once the election took place, there was a thought that there was more animal spirits out there, which would probably lead to a little bit higher inflation rate. But what you see across the board is that the bond market's been relatively contained on what it believes inflation is. However, I want to point out, notice that this is nowhere near the Fed's target rate of 2%. Now, granted, they don't target headline CPI, they target something called core PCE, but the bond market has not believed, really since the pandemic, that the Fed's going to 2% anytime soon. And so it is interesting to see this, just because ultimately, as you think about it, this is how we set pricing. You think about, okay, what's my expectation for inflation? Then I need some risk premium for owning treasuries on top of that. That's the real rate. And then there probably should be some term premium as well. And so, again, looking through those factors, you see here that inflation is still on investors' minds. Shockingly, though, inflation has delivered below expectations. And so this is a surprise index of how inflation came out above kind of what the expectations of the overall market has been. And you can see here that there's been a little bit of dissipation there. And so I will say the last two inflation reports have been relatively good. If you look at kind of the last three, actually, they've been calm, but ultimately they're still too high for what the Fed wants to land. And if you actually take the inputs from today's CPI report and feed them into the components of the PCE report, which we don't get for another week and a half or so, or I guess it's another week or so, once you ultimately look at that, what you see is that the expectation is core PCE will actually go up a little bit next month. So again, I just think the inflation beast isn't behind us. I think we've unleashed another version of it. And once again, it's another kind of regressive tax on the overall system. If you look at forecasts out there, I hate people's forecasts, but I think it's interesting to show what the forecast of inflation would be without tariffs. And again, it's just using Goldman's expectations out there. And again, if you look about this, or you look across this, you notice there's a pretty big chasm there between where we'd be with tariffs versus no tariffs at all. And so I don't think anyone outside of folks within the administration say that tariffs are not inflationary, except maybe one economist I know. So why is the Fed, sitting where it is on rates today? One is we haven't seen some erosion in the labor market. More importantly, inflation is still relatively high relative to their expectations. And notice even for all the talk about waning labor supply and the amount of demand to meet that, what you're finding, though, is there's still more jobs available out there than people available to work. And so to me, this is important because this leads to still balance within the labor market. If you notice that we used to always have, more people looking for work than were actually the jobs out there available. And really, since the pandemic, that whole dynamic has changed meaningfully. In fact, it started changing in the first Trump administration. And where we've been able to fill those gaps a lot is with non-U.S. workers. And so these are the immigrants. Some are legal residents, not potentially citizens. Some probably are not legal residents either. But in general, we have a problem if we lose people in the labor force because we don't have enough people to work as it is today, let alone if we try to get rid of people from this country. And so we'll have to see how that dynamic continues to overhang the market as well. The jobless claims have started to accelerate a little bit. I'm looking at that gold line. That's the continuing claims. Those are the people on unemployment insurance that have received it but are continuing to receive it week after week. The other one are the initial claims. It's the first time when you claim that unemployment insurance. And we noticed there that people are staying on unemployment insurance a little bit longer too. So maybe there is some forthcoming kind of pain within the labor market. This is not a great trend to see. But again, having effectively 2 million people on unemployment insurance right now, probably given the size of the labor force, isn't a huge deal today. But if it continues to ratchet up, it could cause some pain out there in the overall economic growth picture. We're seeing wage growth, although down on a year-over-year basis, still be relatively elevated. In fact, if you take whether it's the average hourly earnings, you take the Atlanta Fed measure, where they actually don't look at, they take the composition into account of the labor force. What you find is that roughly all of these rates are meaningfully higher than they were in that post-GFC pre-pandemic era. And so although they're off the highs, you still have people that are making wages, or at least their year-over-year change in wages has been higher than the inflation rate. This is good for people. That means real wages have been going up, irrespective of which time series you use here. And what that means is that there's still kind of that purchasing power in the hands of the consumer. And I like to tell people, if you want to really know economics, here's the basic principle you need to have. If people have a job, they're in a paycheck. They're in a paycheck, that's money. When you have money, you spend money. That's the economy in a nutshell. And so these are the two things we look at. How are people being employed? How many hours are they working? And whether they're getting wage growth. And maybe there is some kind of kick on this with the one big beautiful bill. Maybe ultimately, with no taxes on tips and overtime subject to certain caps, maybe that helps be a little stimulative to the cohort that is really most impacted by the overall inflationary environment. And more importantly, they're also very impacted by the tariff policies, as both are extremely regressive. And so try to look at the labor force and think about, okay, composition. We know small business is very important for the dynamics of the overall U.S. economy. I think it's roughly almost half the jobs in the U.S. are provided by small businesses. And so this is a good way to think about the unemployment rate. And so what we've done here is you plot the unemployment rate. That's that gold line. And we overlaid on it the 3-month moving average, subject to a little bit of lead, because it takes time for people to from the hiring side. And notice how that hiring is dissipating, and it's kind of pulling that unemployment rate a bit higher. And so again, you're not seeing a contraction. This is just limited amount of folks. So the net amount of people who are saying that they're hiring, there's a 12% net in here. So you can kind of think of that 50-50 line being zero here. This is the net number of businesses out there surveyed that are actually planning on hiring. Doesn't mean they are hiring, but they have plans to indeed hire. So again, you're seeing a little bit of these things. It could be leads and some weakness. It puts us a little on edge, but it's not something that's screaming recession in our face today. And if you look at this too on the other side, and you talk about CapEx, and you look at the business plans, and the month-to-month kind of data is noisy, so you put the 6-month moving average over it. And what you can see here is that the CapEx hiring plans almost look like kind of one of those declines that we've seen, kind of in a recession. Now, again, I'm not trying to say we're in a recession here. And if hiring plans, again, this is CapEx, this is expanding your business, capital expenditures. And so you're seeing here that, there's really a lot less on the hiring side. There's a lot less on planning to expand. And I think some of that is just a lot of the uncertainty out there today and uncertainty around various policies. And if you look at sentiment, it's weakened sentiment, right? And so whether you talk about CEOs, you talk about small businesses, consumers, you look at home builders, we've noticed this really dip in sentiment. There has been a bounce back in the last month or so in CEOs and some of the small business data real quick. We haven't gotten the latest prints on the small business yet. But you've noticed that you're starting to see a little bit of uptick. So maybe that's because, the taco tray where Trump always chickens out there on the tariff policy and some of the relaxations, maybe that's been somewhat accretive to that sentiment out there. Again, those that follow the work we do around here, I don't love sentiment indicators, but just giving kind of how lagged the hard data is right now, I just want to keep it on our radar screen. Again, we're not making investment decisions based on sentiment. We're looking at hard data, but because of some of the noise and front loading of data, we're looking at that as well. And so you notice where the least confidence is in home builders. Well, obviously rates are still high for mortgages. Affordability is quite low for most individuals. And so when you start to look at the housing and real estate area, you can kind of see out here that most of the data is shifting negative. And so it continues to be there. Some of those are input costs as well. Tariffing things like aluminum, steel, copper now as well isn't probably good for an overall home builder as well. So you can see this from the data softening. Why I bring that up is that the market is thinking that the Fed is going to cut rates. And so, is the Fed going to cut rates? I've been in the camp that I don't think they cut this year. I think if the data softens, it probably softens in September, October, as we get more pain from the tariffs and it trickles through. Remember that those who front-loaded inventory are still able to use that today. Once you blow through that inventory, you start to, buying those goods at a tariff level. And so, I think that keeps some pressure on inflation out there. And ultimately, the Fed doesn't want to be seen as reigniting the inflation boogeyman again. But notice here that when the Fed cuts, it's usually consistent with a recession. And so, yes, the Fed cut because they were probably way too tight last year. The market's been saying that. In fact, the bond market fought the Fed for a long period of time, really throughout most of the hiking cycle, having that inverted yield curve. But the bond market's been very bad at forecasting when the rate cuts come. And that dotted line is implied from the Fed curve, or I should say the Fed fund futures curve on the expectations of forward policy and where that market trades today. And so the market right now has been priced in about 200 basis points of cuts. Now, is that because of economic data? Perhaps. Is that because the belief is that there'll be a new Fed chairperson? Perhaps. But I do know that we hear from the administration that Powell needs to cut 200 to 300 basis points off of rates. And so I think the market's trying to listen to that a little bit. And although it's been wrong many times in the past, maybe there is the potential for that as we embark on a new Fed chairperson. And so remember, Jay Powell stays in his term until May of next year. There will be the ability for the administration to appoint one governor. If Jay steps down, they want two. It's probably potentially why Bessent's been out there talking about Powell should step down once his chairmanship is up. But I think the main reason is, and the reason I think it is because President Trump has said it, is that they're worried about the debt. And they're worried about the average interest rate on the debt. And what they really want to do is drive interest rates down so they can help refinance a lot of the debt. And that's why, Secretary Bessent has talked about, wanting to issue very short dated T-bills. He wants to issue a lot of short treasury paper. And he wants to do that because he believes that the next Fed chairperson will help be accommodative and help drive the consensus to get the Fed to cut rates. And so if that's the case, you can see here that the rate we're paying on interest right now is something we haven't seen since the financial crisis. And that's because of that period of very low interest rates. And so when you want to print $5 trillion, you don't want to do it at higher interest rate, you want it at lower. And so these are some of the factors we're going to have to contend with. And Bessent, I saw some headlines out there talking about they've already started identifying candidates for the next Fed chairpersonship. And that's interesting because in the cycles of history, usually that's about 2 to 3 months before the Fed chairperson is their term is set to expire. And this time it's a lot earlier. And I think part of that is that just given the way that they operate, they being this administration, is that they want to really press the market. They want the market to know that they're going to bring in a very dovish person who will help cut interest rates. And so if they can do that, market pricing allows them to help with the overall pricing of securities out there. And maybe that allows them to issue some longer dated paper at lower rates than we have today. So these are all things in the back of our mind that we're playing with in the market. We're looking at fundamentals. Obviously, this doesn't talk about any geopolitical risk or anything else that's going on in the world today. But it's definitely interesting times, especially to invest in assets for closed-end funds. So let me talk a little bit about the markets, what we've seen as of late. I think it's fair to say volatility has dampened a fair amount across markets, specifically in that blue line. The black line is the one you're probably the most familiar with. That's the VIX. You can see it's kind of in a normal trading range here over the last 8 years or so. But notice the Treasury volatility, that's the blue line, is at the lower end of the range we've seen really since the inflation data started to spike. And so I think that's bringing some calmness to the market. That's helping the bond market in general. It's helping certain parts of the bond market also. But we're hoping to see things calm down. But I'm not sure with all the headlines we're seeing, that we're going to go much lower than this today in terms of volatility. That said, fixed income returns have been good this year. If you look through the first 6 months of the year, essentially everything did more than 2.5%. Some asset classes did around 5%, but there's lots of 3s and 4s across the board. But notice what's done really the best. Some of it is high quality assets, things like agencies, agency mortgages. Notice investment grade credit has done quite well. High yield has usurped that return, albeit ever so slightly. But even the risky stuff hasn't done meaningfully better than the high quality stuff. And so what you find is in the first half of the year, you're almost better off buying higher quality assets than on the lower end of the spectrum, outside of probably emerging markets and some of the triple B pockets of the CMBS market. By the way, the triple B CMBS pocket is something that has a lot of risk in it today. Looking at the credit sectors, just outright going down by credit quality, you see here nothing below 2%. IG floaters were the worst at 2.4, emerging market debt at 5.5. But like I said, there's lots of 3s and 4s. And so if you ask an investor, could you get 4% in 6 months of the year? I think a lot of investors would take that. I mean, that annualizes out to an 8% return. So the credit markets have been quite nice to investors, but the problem when you get above yield returns means that potentially pulls some of that forward as well. I bring in the dollar into here too. We started to add some non-dollar positions to the portfolio. They're not reflected in these charts that you'll see in the portfolio yet, just simply because of some of the policies. And if we do end up getting that easing cycle, although it could indeed be somewhat inflationary, it probably is negative on the dollar. But notice how overvalued the dollar's been for the last few years. And this is something called the real effective exchange rate. So it's not actually looking at kind of the actual thing. It takes into account the bilateral trade partners and how costs are in various countries. But you can see here that the US dollar has been overvalued for a very long period of time. And so looking at that, maybe it's right that we do need to ease and really bring some devaluation to the dollar. And so we'll see how that plays out over the next few years. Also interesting is that the relationship between 10-year and the Dixie, this is the developed market dollar index, or it's the dollar index, but it uses primarily, it's heavily weighted by Europe, Japan. So I think it was a developed market kind of world. It has no EM currencies in it. Notice the divergence in these two time series. Maybe some of this is some marginal repatriation of capital outside of this country. Some of it is interest rate differentials coming down a little bit too, where the back end and the 10-year part of the curve is kind of held up. But it is kind of interesting to see that there's this widening gap between the two. And I point that out because ultimately, if the dollar is going to continue to decline, it probably does drive interest rates down a little bit. But also don't forget that if we have a devaluation in the dollar, that ultimately does lead to some inflationary behavior because of that increase in the net imports that we do into this country. Remember, we are an importing country. So that's the other thing when thinking about the inflation boogeyman, is that possibly this devaluation of the dollar, especially as of late, hasn't really showed up to the trade data yet, could lead to a little bit more inflation on the back half of the year. And that's something that we believe will probably come to fruition in the second half of 2025. Yields, there's still some attractive yields out there. There's 7s, there's 8s. If one wants to take risks, there's 10s and 11s out there as well. So there are still things to do, just it's how much risk does one take. And when I look at the lower quality end of the spectrum, really all that the significant yielding parts are at the lowest end of the quality curve within the respective markets. That's kind of how it should be when one thinks about it. But notice how big the gaps are when you go from single B to triple C credit, right? Or you go from triple Bs to double Bs in some of the other parts of the market. So you're seeing the credit curve kind of steepen a little bit out there, which means that what you're finding is that people want more risk premium for taking that risk. I think that's rightfully so. We live in a riskier world today than we did, let's say, 4 months ago. Again, that's the risk comes from uncertainty. It comes from the geopolitical side, but the higher quality parts of each market have been trading kind of relatively well, as I think I would say that as well as the equity market, for instance, in the U.S. So here what we do is we look on the vertical axis is the percentile ranking over the last 10 years, and where the rankings lie for the various asset classes. You can see some of the cheapness sits still in the mortgage market, whether that's non-government guaranteed mortgages, whether that's the agency mortgages, some CMBS as well. But a lot of the broad-based markets have gotten tighter than what we see there. And so I think it's important that these are just broad indices. Again, security selection can help you through all of this as well. And again, like for instance, in CLO AAA, we can buy stuff we think is in the 55, 60th percentile today versus kind of these broad indices. And so I think it's important to realize that a lot of the broad stuff has gotten pretty tight in the public markets. And so what that connotes to us is probably one needs to be a little bit more conservative when constructing portfolios. So I want to thank everyone for tuning in. Thanks for the questions. I came in under the hour. We appreciate everyone's support of DoubleLine. We'll be back at you next year to give you an update on these funds as well. And for all things DoubleLine, go to our YouTube channel, youtube.com/DoubleLine Capital. And you can go to doubleline.com on our website for all of our current materials as well. Thanks again, everyone. Take care and have a great summer.